Hi, I'm John Mark Young, and welcome back to our Question of the Week video here at Whitaker-Myers Wealth Managers. Today, we're diving into a topic that can save you thousands of dollars over the life of your mortgage. What is that? Well, it's a question we got asked from a client, Phil in Daytona Beach, Florida. And Phil asked this: because of a recent move we've made to Florida, our Ohio property did not sell at a price, giving us enough of a down payment to avoid PMI on the Florida property. Well, that sounds normal, Phil. Ohio houses probably don't sell for as much as Florida houses, although Ohio houses, like any market, is selling for good prices. So I would like to know, this is Phil asking, how to remove that private mortgage insurance, or PMI, from my new Florida mortgage. Well, if you're a homeowner looking to lower your monthly payments, this video and question is the question for you. So let's get started into answering Phil's questions. So first things first, before we dive into how to actually remove PMI from your mortgage, let's talk about what exactly is PMI. PMI stands for Private Mortgage Insurance, and it's a type of insurance that lenders require when your down payment is typically less than 20% of your home's purchase price. It protects the lender in case you default on your loan, you stop making payments, but it's an extra cost that you, the homeowner, have to pay. That's right. It protects the bank or mortgage company, but the cost of that protection is fully borne on you, the person borrowing the money. It's kind of like the mortgage company saying, you know what? If you die, you can't pay off this mortgage. So we are going to buy life insurance on you, we, the mortgage company, to protect your family in case you die. Wouldn't that be such a nice thing for them to do if we could force them, the banks or mortgage companies, to protect us with life insurance? Well, we can't do that. But they can, and they do, through this PMI thing, which protects them, but costs us. In the words of Michelle from Full House, how rude. So let's dive into fixing this egregious error that the mortgage company has put on you, Phil. So the first thing you're going to want to do, step number one, is you got to know the terms of your loan. Okay? You got to understand what the rules are for your PMI insurance. So review your mortgage statement or contact your lender to find out the terms of your PMI. Most conventional loans allow for PMI to be removed once your loan to value ratio, or LTV, as it's said in short, reaches 80%. They automatically do it at 78% typically. This means you've paid down your loan enough to have at least 20% of the equity in your home. More than likely, most homeowners, after the last 2 years of paying down their mortgage, have simultaneously seen their value increase as well. And this creates what is called equity in your home, which reduces your loan to value. Okay? And by the way, it's 78% of the original value, so not of your current values, when they'll automatically take it off. So again, you've got to get the appraisal. Now, equity is the difference between the current market value of your home and the amount you still owe on your mortgage. Okay? Value, mortgage, difference is equity. As you make payments, your equity increases, mortgage goes down. As the value of property increases, equity increases. It's a torpedo that makes homeownership fun, notwithstanding the consistent improvements and repairs one must make that are rarely free of time and money. So it's not like homeownership is complete bliss, but that is one major value. So how do you calculate the equity? Well, that's step number two after you find out what you actually need to reach, what point you need to get to in terms of your equity. To determine if you're eligible to remove your PMI, you've got to calculate your current equity. So use a recent appraisal, or if you haven't had one, more than likely you probably haven't, go to a real estate website like Zillow, and you're actually going to get an estimate of your home's current value. Subtract your remaining mortgage balance from this value. If the result is 20% or more of your home's value has equity, you're in good shape. You should go to your mortgage company and request. Let's go through a quick example here. All right. Let's say Zillow says my house is worth $300,000 and my mortgage statement says I owe $240,000. Well, I have $60,000 of equity, the difference of the value and the mortgage, $60,000. And that is 20% of the home's value. This means I could potentially remove my PMI insurance in this case. So how should I do that again? That's step number three. Contact your lender now to start that process. Once you've confirmed that your home equity is at least 20%, reach out to your lender and request the removal of PMI. That's going to be an official process you go through. Some lenders are going to require a formal appraisal to verify your home's current value, so be prepared for that potential cost. Oftentimes, this appraisal will be on your dime and probably cost in the range of about $500. At worst, if you get a bad appraisal, you have a full document showing the value of your home, and you know where you need to get your home down to based on that actual appraisal. Remember to tell the appraiser about any improvements you've made to the house that are meaningful. Like something like painting a room is nice. I'm sure your kids love their nice new painted room, but that is not going to add value. Redoing all the floors, upgrading the kitchen or bathroom, doing a costly landscaping project, these are things that are going to add to the value, and you'll definitely want to let your appraiser know that you've done them. Then you'll probably they'll have you send a written request or have you sign documents asking them, the mortgage company, to remove your private mortgage insurance, PMI. Include any necessary documentation, such as the appraisal or the mortgage statement showing your payment history. And that's step number 4 is before you can probably even do this, they're going to verify that you have good payment history. So you need to maintain that. Lenders want to see that you're being responsible with your payments because remember, PMI protects them in the event you're not responsible with your payments. So you need to ensure that you have a solid track record of on-time payments, as this will support your requests. Many lenders are going to even require for you to apply that you be on time with your payments for 12 months or longer. And again, they might not even consider the request unless they see that type of payment history. So removing PMI can save you a significant amount of money each and every month. And if your lender approves your request, your monthly mortgage payment will start decreasing because they'll just take that right off the payment. It will no longer be included in your escrow, allowing you to put that extra money towards your next baby step, such as baby step 4, baby step 5, or maybe even baby step 6, paying off that house, getting it to 0. That extra PMI can now go towards principal. So there you have it, Phil. The steps to remove PMI from your mortgage, very easy. Get in contact with your mortgage lender, make sure you have the equity, then submit the application. Remember, building equity in your home is key, so making sure those payments are on time and meaningful and watching your investments grow are very fun parts of being a homeowner. And eventually, it lowers to 0 when you pay it off. Even if it didn't lower to 0, and of course it will, again, because you will pay off your house. As anybody working through the baby steps, their average payoff time is 7 to 8 years if they remain gazelle intense, maybe a little bit longer if they don't, but at least 15 if you're following Dave's principles would be the maximum amount of time you've had there. But even notwithstanding the fact that it will go to 0, what a mortgage payment does is it locks in your housing costs as it relates to the monthly payment. Again, you might have more as it relates to improvements, repairs, those sort of things, but it locks in that monthly housing cost. And that is so important because as we've seen with our Consumer Price Index, our CPI reports, our inflation reports, the thing that is driving inflation still, the reason we're not getting it down to 2%, the last few reports, auto insurance, maybe why you should shop your insurance with an independent agent, and shelter costs, housing costs. If housing costs continue to rise on you time over time, it's going to be hard for you to engage in those other baby steps that you need to engage in, which is why at some point you want to lock in that housing cost. And that's what a mortgage allows you to do, and again, eventually allows it to go away. So it's why having a house is so important, but as Dave says, you don't want the house to have you, which is why we think it's so important that you get that 20% down payment so you don't even have to deal with PMI. But if you do, this video will help you walk through the steps to remove PMI. So thanks so much for watching this week's video. If it was helpful to you, would you do us a favor? Hit the like and the subscribe button. The like button helps push our content out to more people on YouTube, Google, and Rumble, as well as the subscribe button allows our content to come out to you as we release it. You can also go to the comment section of this video where you can schedule a meeting with any of our financial coaches or our financial planners. They'll help you in baby steps 1, 2, and 3. The coaches will get out of debt, stay out of debt, live on a budget. And our planners will help you on baby steps 4, 5, 6, and eventually get you to 7 where you can live and give like no one else. Thanks so much. We'll look forward to seeing you next week.